Good morning, hunters. Welcome back to the Daily Hunt for Multibaggers on this Thursday, December 4th, 2025. We've got a packed show for you today.
That's right, Ethan. Our AI dug deep into yesterday's market chatter, specifically from Wednesday, December 3rd. And wow, we saw a lot of fresh activity. We're looking at a significant number of newly flagged stocks this morning, indicating a very active market. And I'd say the overall sentiment is a fascinating mix of promising growth plays and some pretty risky bets.
Definitely, Brooke. It's an exciting time out there, with a lot of potential buzzing in the air. Let's dive into the specifics.
All right, let's kick things off with Micron Technology, ticker MU. Our AI-driven analysis gave it a slightly bullish sentiment today.
And for good reason, Brooke. Micron is undergoing a major strategic pivot, exiting their lower-margin consumer business to focus entirely on high-bandwidth memory for AI and data centers. Social media discussions are really highlighting this transformation and the potential for much higher profit margins. Remember, we had it as a stay away on November 12th, but then upgraded it to buy on November 15th, and it looks like that trajectory is holding. We even see significant insider buying, which is a great sign of confidence.
I hear you, Ethan, and the 46% revenue growth is certainly strong. But let's temper that enthusiasm with a glance at the KPIs. A PE ratio of over 30 and a debt-to-equity of 28.34 are definitely high. While the pivot to HBM could improve margins, we need to ensure the market hasn't already fully priced in this future potential. The insider buying is a positive, but that debt level warrants caution.
Understood. But for today, given the strategic clarity and insider confidence, our AI-generated insight for MU is a buy. Next up, we have Ondas Holdings, ONDS. This one is generating a lot of buzz with a bullish sentiment score.
Yes, the news of Ondas securing a multi-year government contract for thousands of drones is huge. They even beat out major defense primes, showcasing their competitive edge. This has the potential to dramatically boost their future revenue. We had it as stay away previously, and this news certainly sounds like a game changer.
It absolutely does. It's a validation of their technology, a massive vote of confidence.
Well, Ethan, while the news is exciting, let's look at the financials. Ondas is currently unprofitable, with a negative net profit margin and EPS. Its current revenue growth is a low 5.82, and the debt-to-equity ratio is a high 3.7. The stock has already surged from under $1 to nearly $9, indicating much of this future potential is already priced in. For investors prioritizing current profitability and risk, that's a big hurdle.
Point taken, Brooke. So, despite the groundbreaking contract, the financial reality right now means we're classifying ONDS as a stay away. All right, let's talk about AMD, Advanced Micro Devices. We're seeing a mildly bullish sentiment today, largely driven by comparisons to Intel.
Indeed. Social media discussions are positioning AMD as a key player in AI, with mentions of strong partnerships and analysts like TD Cowen calling it a best idea for 2026. They do have impressive 35% revenue growth. While we've rated AMD a stay away many times, we did have it as a cautious buy twice in November, and this AI focus continues to be a driving force.
Exactly. That AI narrative is powerful, and the market clearly values their strategic position. The insider buying is also a sign of confidence.
It is, Ethan, but the PE ratio of nearly 114 is incredibly high, suggesting that a huge amount of future growth is already priced in. Couple that with a debt-to-equity over 6, and you've got a very demanding valuation, susceptible to any slight disappointment. Given its history of being a stay away for us, this kind of premium pricing makes it hard to justify.
For today, our AI analysis suggests that AMD, despite its promise, should be classified as a stay away due to its elevated valuation and leverage. Now for Snowflake, SNOW. This one is a head-scratcher with a very bearish sentiment despite some positive news.
It's a classic case, Ethan. The company did beat Q3 earnings and revenue estimates, and their AWS Marketplace volume actually doubled, but the stock still dumped hard, with users citing weak guidance as the culprit. It's a clear signal that the market's expectations were far higher.
So even with the beat, the future outlook wasn't enough to satisfy investors.
Precisely. When you look at the KPIs, it's operating at a significant loss with a negative net profit margin and EPS. The price-to-book ratio is an astonishing 37.8, and debt to equity is over 113. That valuation simply cannot be sustained with negative profitability and weak guidance.
That makes perfect sense. First-time rating SNOW on the show, and our AI-generated insight is a definitive stay away. Moving on to Amazon, AMZ. We're seeing a slightly bearish sentiment for short-term rapid gains, but the fundamentals are strong.
The social media chatter describes AMZ as always flat in the short term, which is a key sentiment driving the slightly bearish take on quick profits. This contrasts with its consistent upward trend over the past year. While we had it as a buy on November 30th, the KPI of significant net insider selling of over 23 million shares is a cautionary flag that needs to be acknowledged.
But you can't ignore the long-term story here, Brooke. Revenue growth at 13.4%, strong net profit margins, the continued dominance of AWS, and advancements in AI customization all paint a very bullish long-term picture. Wall Street analysts are consistent too.
I agree on the long term, Ethan. The company is fundamentally solid. However, for those seeking quick appreciation, the high PE of 33, combined with insiders offloading shares, suggests that immediate explosive upside might be limited. We're downgrading from a buy.
So we're classifying AMZ as a cautious buy for today's market commentary, specifically for long-term investors. Now for a perennial favorite, Tesla, TSLA. Despite some bearish hopes on social media, the community sentiment is actually moderately bullish.
It's true, Ethan. The comments mock bearish predictions, emphasizing buying the dip and dismissing critics' timing. TD Cowen even has a $509 price target on robotaxi progress.
And that robotaxi push, Elon Musk's grand vision, that's what drives the growth narrative for TSL. We've had it as stay away many times, but sometimes speculative gamble, showing that underlying optimism.
I appreciate the optimism, Ethan, but Michael Burry's rigidly overvalued claim seems well-founded when you look at the KPIs. A PE ratio approaching 300, a PB ratio over 18, and a debt-to-equity ratio of 17 are simply unsustainable for its 11.6% revenue growth. Germany's sales are even down year over year. That's a significant financial risk.
Fair points, Brooke. The high valuation leaves little room for error. Given these metrics, TSL remains a stay away for us today. Let's turn to NVIDIA, NVD. Users are slightly bullish, even with some short-term dipping.
The sentiment is mixed but leans positive, with some calling it the #1 company in the world, thanks to its phenomenal 62.5% revenue growth and over 53% net profit margin. Morgan Stanley even has an eye-popping price target. We've often had NVIDIA as a buy, including just yesterday on December 3rd.
Exactly. Their role in AI is unparalleled, and those numbers are just incredible. What's not to love?
What's not to love, Ethan, is a PE ratio of 44.45, a PB ratio over 36, and a debt-to-equity ratio of over 9. While the growth is amazing, that valuation already prices in perfection. And importantly, insiders have been net sellers of over 6.5 million shares. That's a significant signal from those closest to the company. We were a buy yesterday, but these risks, especially the debt and insider selling, are too high at this valuation.
A tough call, but based on those KPI-driven insights, we're downgrading NVDA to a stay away today. Moving on, UPath, PATH. This one is generating very bullish sentiment from users, with talk of consistent earnings beats and the potential of their Maestro software.
That's right, Ethan. The social media buzz is through the roof. News confirms they just beat Q3 estimates, leading to a stock rally. Users are convinced Maestro is a game changer for enterprise automation.
So, all green lights, right? People are setting high price targets for its future potential. We've had it as stay away often, but the community seems to think otherwise now.
Not so fast, Ethan. A PE ratio of almost 500 is absolutely astronomical. The company is barely profitable with a net profit margin of only 1.35% and a negative operating margin. And here's the kicker. Insiders have been net sellers of over 2 million shares in the last 6 months, sharply contradicting all that retail enthusiasm.
Wow, those numbers are certainly jarring against the sentiment. So for PATH, despite the user optimism, it's a stay away. Finally, let's talk about Hudbay Minerals, HBM. Sentiment is cautiously bullish thanks to a copper-fueled rally.
The stock is definitely seeing momentum, trading near its 52-week high, and there's a small amount of insider buying. That signals some confidence in the rally.
This is its first rating on our podcast. Right. Copper demand, future-facing metals, that's a powerful narrative for growth, Brooke.
It could be, but let's look at the underlying health. We're seeing negative revenue growth of minus 28.6% and an exceptionally high debt-to-equity ratio of 38.67. This isn't just leverage, it's a precarious financial position. While copper prices might boost future revenue, the current financial state screams caution.
Understood. The risks outweigh the current positive momentum. So HBM is a stay away today. All right, let's wrap up our daily hunt with a look at today's AI-generated candidates for deeper analysis. Investigate as buy. Micron Technology, Inc., MU. Investigate as cautious buy. Amazon.com, Inc., AMZN. Investigate as speculative gamble. UPath, PATH.
And that brings us to the end of today's Daily Hunt.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in. We'll be back tomorrow with more AI-generated insights.
Happy hunting, everyone!